Hello, this is my third attempt at Chat with Brandy, the 5th episode. I really hope this one works out. Sorry about my previous attempts if you already watched those. So we're going to come back into episode 5 of Chat with Brandy. This is business budgeting. So last week we talked about personal finance, personal budgeting, debt repayment, and all that kind of stuff. So if you would like to watch that and you missed it, just go to my Facebook page and click on the videos tab and you will see it there. This week, we're going to focus on business budgeting. So how much to save for taxes, how to set goals for your business and measure your progress, and of course, how to grow your profit. So this is going to apply to you whether you're a sole proprietorship or a corporation. But most of my advice, especially in this video, will really serve the smaller business community. So people who own a corporation or a sole proprietorship that is bringing in sales of less than $300,000 is really where my specialty lies. And so most of this will be the most relevant to them. Just like last week, the advice that I'm going to give doesn't really come from one particular source. I do follow some professionals in this area, and I will be linking some things in my show notes just to give you guys some additional resources. But a lot of this is mostly just from my own experience running a business, as well as, of course, all of the experience that I have working with clients from all different sizes and industries. Again, this week, I want to preface kind of all of the math, brain side of this with acknowledging that there is a huge emotional component to business budgeting, especially when it is a small business, because you usually have just kind of one entrepreneur that has really put all of their heart and soul into it. And it can be really difficult to, just say, these are the numbers, just fix it up. It's all black and white. Like it's difficult to say it that way. So I think a really good tip for if you're ever feeling frustrated in your business, and not just with money, but everything, is kind of going back to that why you started the business in the first place. And I can pretty much guarantee that there was some element of helping yourself. So, increasing income, increasing your flexibility, whatever, but there was also probably an element of helping other people. So providing a product or a service that's going to solve a problem. So I think if you kind of go back to that original mission and that original why, it can usually help to center you and help to kind of re-motivate you to continue growing in your business and continue evolving in a healthy way. Okay, at the end of the video, again this week, just like last week, I will provide some tips to kind of help you with the heart side of things. But for now, let's get into the numbers. Okay, so the first thing that we're going to do is we're going to pull out your most recent income statement. So if you're watching this live, you can always rewatch it later. Or if you're watching this on the replay, you can just pause it now and go get your most recent income statement. So sometimes this is also called a profit and loss. If you get your books done monthly or quarterly, which I of course recommend, you're going to go with your most recent one. If you only get them done annually, just go with last year's. If you really need to get caught up and you don't have anything decently recent, I'm going to recommend that you get that done first and foremost before you really dive into this video. You really need to have your finger on the pulse when it comes to your business finances if you want your business to grow in a healthy and successful way. Okay, I can't kind of underline how important having an up-to-date bookkeeping system is for any business's financial health, okay? So we have our income statement. This one is a really basic one. So yours probably looks a lot more detailed than this, and it also probably doesn't have a giant orange blob on it, which I'm almost thinking now I probably should have drawn like a jack-o'-lantern on it or something like that. But anyways, so up here, you're going to see at the top of your income statement, you're going to see gross revenue. And that is all of the income and all of the sales that has come into your business in that period of time. So in this example, I put $100,000 was their total sales. Now, cost of goods sold. Okay, so this applies to people who sell a product or for whatever reason have some sort of costs associated, and not operating expenses, but some sort of costs associated with the actual item that they're selling. So a really good example would be if you obviously purchase items wholesale and then resell them at a higher price, or even if you are a maker of some sort, you have to buy your ingredients, buy your packaging, put it all together. Those are your cost of goods sold. Or if you're like a contractor, you would have like your rental materials in there, and then subcontractors would also be in there. Not your real employees, but again, cost of goods sold is kind of in the name, right? So then down here, you have your gross profit. Now, if you're a service-based industry and you don't actually sell any physical products, you likely will have nothing here. You probably will it'll just start here on your gross profit. Okay, so this is the number that we're really going to be concentrating on for the rest of the video. When we're doing our calculations, it's all going to be based off of your gross profit. Okay? Okay, so we've gone through this part. Now, I don't have any actual numbers here under operating expenses. I just don't really need it for this example, but you will have on your income statement all of these different expenses. Here's some examples of what you might have on here. So office lease, vehicle expenses, supplies, telephone, advertising, travel. Salaries and wages may or may not be on there. That's going to depend on whether you're a sole proprietor or a corporation. And even if you're a corporation, you may not pay payroll. So you may end up paying dividends instead. So in that case, it's not going to be on there. Your income statement should add up all of your expenses at the end. It will reduce this by your total expenses, and you'll end up with your net profit. So if you have a zero or a negative number on net profit, that means that you had a business loss. In other words, you spent more money than you made, okay? If you have a positive number, then congratulations, that means that your business made a profit. But don't go too crazy because the taxes hasn't come out of that yet, okay? So we've talked about operating expenses. Okay, there's two major things that are not going to show up on this income statement. And that is going to show up on a different statement that you may have like with your income statement. Usually most people would, like most accountants and most bookkeepers would give you these two statements together. So the other one is called a balance sheet. We're not going to go too far. We're not really going to discuss the balance sheet today. We're going to try to kind of keep it simple, but just for the purposes of this, I'll tell you these two items that may be on your balance sheet and not on your income statement. The first one is capital expenditures. So if you purchase equipment or a computer or like a vehicle or whatever that is deemed to be a capital expenditure, and again, any tax professional is going to know what that is, we can only claim depreciation on these items. So that means that you can only claim bits of them in each year for an extended period of time. So you may see depreciation or amortization on your income statement, but you won't see the actual piece of equipment on there. The other thing is debt repayment. So if your business has debt and you're repaying the debt, that's still obviously a cash outflow, but it's not going to show up on here. The only part that's going to show up on here is the interest on that debt. But you will see these items on your balance sheet. So just to kind of wrap this little part up, if you are looking at that net profit and going, there's no way I made that much profit, look on your balance sheet. That may answer some questions for you. Okay, so now we understand our income statement, but are the numbers that are on there good or bad? So there's a couple of measurements that we're going to go through that will help you indicate where things are good or where you can improve. So the first one, and this again only really applies to people who sell a product or for whatever reason have cost of goods sold, hopefully this is going to stick, is the gross profit ratio. So this is where we're going to divide our cost of goods sold number by our gross revenue, and that's going to give us a percentage. So in this example, it's 25%. It stands to reason that you would want this percentage to be as low as possible because, of course, then that's more money in your gross profit, right? Now, a lot of industry professionals would say that 25% is a really good target to go for, but I personally think that it really depends on what industry you're in. So one way, this is kind of like a good tip for you, one way that you can kind of find out what other companies that are in the same industry as you are in do on their ratios, and all the ratios that we're going to talk about today is you can go to a website, and I'll link it later, called allreports.com. And by the way, I'm not affiliated with them at all. It's just a really good free resource that I think you guys could find useful. So you go to allreports.com. It has a list of all the publicly traded companies, and you can search by name of the company, or you can search by industry. So if, for example, you're a bakery, and you want to see what other, you know, bigger bakeries or confectionaries are doing, you could look up like Rocky Mountain Chocolate Factory. And obviously their numbers are going to be way different than yours, but the percentage is really what you're looking at. So if you look at Rocky Mountain Chocolate Factory and you go, yeah, they're doing 30%, then you know that maybe that's the target that you want to be going for. Hopefully that makes sense. Okay. So that is the first measurement. The second one is operating cost ratio. This one applies to all businesses, even if you're a service-based industry. Okay, so this one is going to tell us what percentage of our gross profit is going to operating costs, okay? So I'm going to show you some examples here. So on this side, we have our sole proprietor, okay? So this means that you're not paying payroll. Sole proprietor, the way that it works, you don't pay payroll to yourself, just basically what's left at the end is for you and for taxes. So what we want to do is when we're looking at these operating costs, your target should be, well, here you can see it's 30%, but I've broken it down a little bit further. So office lease, office space, your target should be under 10% of your gross profit. And I know that might come as a shock to some of you, but it's like max 10% is what most professionals would agree upon. Okay, then the rest of it, so you can see here there's no salaries, no wages, so everything else, so all your supplies, everything else should be 20% or less. So that means that your total operating expenses should be under 30% or lower than this number. Okay, so in this example, the total expenses would be $22,500 if they were absolutely perfect. That way, well, we'll go into the profit part later. Okay, on the corporation side of it, so you're a corporation that's paying payroll to yourself diligently and maybe your other employees as well. So that means that you're remitting source deductions already, everything's kind of good. When that happens, you get to claim that as an expense from your business, okay? So in that case, you would still try to aim for under 10% for your office space. You would still try to aim for 20% or under for everything else, but your salaries and your wages, which would include your personal taxes, because again, you're doing source deductions, could be up to 64%. And I know that seems really random, but we will get to, it's not just random, okay? So that means that your total expenses are 94% of this when you're a corporation paying payroll, okay? So in this example, it'd be $70,500 has already gone out the door, okay? So then this brings us to our net profit. So if 30% of this is operating expenses, then that leaves 70% as net profit, which means that you can split that between your own salary, your own taxes, and then of course, if you decide that you want to leave some money in the business for like investing in equipment or a bigger office space or more employees or something like that, you could split that out however kind of you want. And we will talk about taxes a little bit later, but you can see that in this situation where you don't have payroll as an expense, your net profit should be like a lot higher than on this side where your net profit, so you're paying payroll, your net profit's only 6%. So I put 5% as kind of a goal to leave in the business. You could go higher if you wanted. Like again, if you know you really want to make some big investments in the future, you could leave more in. But 5%, if you leave only 5%, so 6% essentially, that's $4,500, but 1% is going to go to tax. So that's why I said 94%. We're leaving out 6, but 1% is going to go to tax. So really 5% is for the business to keep the profit in it, and then the other 1% is going to tax. Okay, now this part is a little bit confusing. I'm going to try to explain it as best as I can. In Alberta, corporate tax, if you're in this kind of income range, is 12%, okay? But it's 12% of this number, excuse me, it's 12% of this number. So that can be really difficult for you to determine as you're just making sales. So the way that I have kind of tried to make this simpler for you is if you save 1% of every dollar you make here, then you should be fine for tax at the end of the year. I hope that makes sense. If you decide that you want to keep more than 5% as profit in the business, for every 5% more that you want to keep an extra 1% for tax. So for example, if you decide you want to keep 10% of this as profit in the corporation, you would save 2% tax. All the way up to, like, if you want to keep 25% as profit in the business, you would save 5% tax. So in that case, you would need this total expenses to be at 70% and this would be at 30%. Okay, I hope that makes sense. If it doesn't, it's a really good idea to sit down with a tax professional who can kind of look over your specific scenario and give you numbers instead of just percentages. It could be a lot easier that way. But I hope this is giving you some kind of general good advice. Okay, so then on this side, we will talk about taxes in a moment, but first, before we move into taxes, so you know that your operating expenses should, like, your target should be about 30%, or on this side, it should be about 94%. Okay, so you know your target. So if you're looking at your own income statement right now and going, it is way different than what Brandy is saying, what I want you to do is, just like last year, take your red marker, or in my case, orange marker, and go through each line in your income statement, okay? And you can go, okay, I know that this particular item gives me a profit. For sure, it gives me a profit, okay? So it directly affects the amount of revenue that I bring in, okay? So you can go and put a P next to all of those ones. Anything that doesn't directly give you a profit, you can put an NP, so non-profit, beside it. You can even drill it down further by saying, does this expense increase the quality in the product or service that I'm providing, or does it not increase the quality, right? And that's a good way that you can know where to go and cut expenses, okay? Just another kind of thing that I want to say is, I feel like so many business owners get this idea in their mind that in order to have a business, they need to have like X, Y, and Z. Okay, so they're like, well, I should have an office space. I should have employees. I should have this brand new vehicle with my logo on it, right? This is not true. If you are helping people and you are making money, my friend, you are in business, okay? That is really all you need. For most of you guys out there that are running these small businesses, the real product, the real thing, the real asset to your business is you, okay? So you don't necessarily need all of the flash and bling, right? Some expenses for sure. You're going to need some expenses. That's absolutely, and that's why we say 30%, you know, every business has its costs. But I think, you know, again, you need to kind of look at, I think a lot, and again, sorry, I'm kind of getting off track here, but I think a lot of people are concentrating on this. They're concentrating on revenue, like I need to make sales, but they're not concentrating enough on the profit part of it. So you can make as many sales as you want, but if it's all going out the door in expenses, then you're not profitable. You're not doing what's best for your business, okay? So there's this theory called Parkinsons Law, which I'll link some more information on later. It basically, when it's applied to money, it basically says expenditures rise to meet income. So kind of what this means is that if you don't keep your eye on the operating expenses and you only concentrate on increasing your revenue, which of course you need to concentrate on that part of it as well, but if you only concentrate on this part of it, as your revenue increases, your expenses will increase just to match them. So really, you're not affecting your bottom line. And in turn, you're not affecting your healthy profitability of your business. So if you can be aware of Parkinson's Law and try your best to actually break it, you will see growth in your business. And again, sometimes we need to kind of go back to our why and our original mission and say, can my business make a bigger impact if it's profitable? And the answer is likely going to be yes, okay? All right, so let's talk taxes. So the big thing here that I want to relay is having to pay taxes is not a bad thing, okay? Paying taxes means that you have a profitable business. Obviously, we want to work to make sure that you're not paying more tax than you should be, but as a business owner, I really want you to change your mindset about paying taxes. If you're saving appropriately for them and you're budgeting appropriately for them, they do not need to be a big nasty burden on you. They're just another cost of doing business, and really, in reality, they're a great health indicator, okay? So again, if you're going back to if you're this corporation, Okay, so we kind of talked about this 1%. You're saving your 1% for every 5% of your profit. I hope you guys get that. Now, if you're a sole proprietor or if you're a corporation, but you don't pay yourself in payroll, so it means that you're just taking draws whenever you want. Usually what your accountant would do with that at the end of the year is they would issue it to you as a dividend. So that means that you would get a T5, but there, again, there's been no taxes remitted on your behalf, either personally or through the corporation, okay? So if you're in one of those two scenarios, you're in this side. I have a very general guideline for you. Okay, so first of all, it's more difficult to come up with this instead of just the 1% scenario because, first of all, there's CPP to deal with. There's the other issues of there may be other income coming in from other sources. There may be deductions coming from other sources that I don't know about, but this is a very general guideline and it's only for Alberta residents, okay? So taxes. So I kind of laid it out here. If your gross profit, so again, this number we circled in orange, okay? If your gross profit is less than $30,000, save 10% of your gross profit. So every time you get a sale and you know, okay, so I've taken my material cost out of this, this is the actual amount that is my gross profit, save 10% of it for taxes, okay? That's gonna be your personal taxes. If it's between 31 and 45,000, save 15%. If it's between 46 and 100,000, save 20%. And if it's between 100 and 250,000, save 25%. Okay, that should more than cover you for your taxes, Alberta and federal, as well as CPP. They're kind of high, but the reason why is because I would prefer you to save more money than you need. Okay. So again, going back to the corporation paying dividends, you need to be aware that with dividends, both you and your corporation are going to pay tax. So it's pretty much even with payroll, but I don't want to get too into that right now. And hopefully you can see that. Corporations paying dividends, so the corporation should save 12% of each draw that you take. So every time if you take like $1,000 out, make sure that you're squirreling away 12% of the corporation's money to pay for taxes, and then out of that $1,000 that you take, you personally should be saving 15% for your own personal taxes, okay? I hope that makes sense. Okay. Oh, none of this includes GST. So the income statement does not have the GST you collect. It does not have the GST that you pay. It has no GST or HST or PST or whatever you charge on it at all. It's completely separate. So my best quick tip for that is if you are charging, like in Alberta, we charge 5% GST. I think that you should just treat that money as if it's not your own, put it in a separate bank account if you can, and when it's time to remit, you're not going to owe that whole 5%. So again, you're saving more than you actually need. But I think that that's probably the easiest and most actionable way to save for GST. Okay, so tips to make this easier. So like last week, I'm going to recommend that you have an accountability partner, but this time it's probably not going to be your spouse or your best friend. Business accounting and taxes can be pretty complicated, and it's a great investment to have a professional on your side. Okay, so you're gonna, if you hire a monthly bookkeeper, for example, you're gonna get monthly up-to-date statements. You're gonna be able to measure your progress. Plus, you should be getting detailed estimates on how much tax you should be saving, like in dollar amounts. So it's very easy for you to kind of figure that out. And then you can spend that time that you would trying to figure out this math, trying to do this on your own, you know, making your products or servicing your clients, doing what you're good at in your business, right? My next tip is that if you are an owner of a corporation, okay, if you're an owner of a corporation, you are legally required to have a separate bank account from your personal one. If you're a sole proprietor, you aren't legally required to do that, but it's a really good idea. It makes bookkeeping and tracking your expenses and your income so much easier. And also, if you use a software program like QuickBooks Online where you can actually hook up your bank feeds to it so it just dumps in all your transactions, at least then it's not your personal bank account that's just dumping in all your personal stuff, right? My next tip and it kind of goes back to cutting your expenses, is if you use software in your business, like so many of us do, take it upon yourself to do a subscription audit every 3 or 6 months. So kind of go through your credit card statements, or yeah, it's probably going to be on a credit card most times. And look at all of the software subscriptions you have on there and make sure you're still using them and that it's still worth the money that you are spending on. I want to make sure that you're getting value. It seems to me like with the way that software companies are now making you pay monthly for everything, it's so easy to just forget you have it, right? And I think that's almost the point of it. My next tip is to book dates with yourself quarterly to review your business goals, financials, what's working, what isn't. I will do a video on this tip specifically closer to the end of November when I do my own quarterly review. So you can kind of see what I do and I'll give you some tips and that kind of thing. And then I already said this, but it bears repeating. Annualreports.com can be a really useful and free resource for you to kind of check on other, obviously huge companies, like publicly traded companies that are in your industry. So you can kind of see like, well, I see that their operating expenses, they're running it at 25%. Maybe I should, aim for that. And again, I'm not, if right now your operating expenses are at like 50%, I'm not saying go and cut 20% today. I'm saying move towards it. So if you can cut 1% today and then 1% next week, right? Like you're moving towards it. Progress. Next week is the Halloween special. So hopefully we won't have technical difficulties like I did today. Thank you all for your patience. I have a special guest coming on next week. I don't want to give too much away, but it's going to be spooky and fun and educational. So I look forward to that and I hope you do too. So for today, I hope you have a great day and we will see you next week.